What's good, guys? Welcome to Just Lovely's Hustle, Love, and Elevation. Today we're going to get into stocks, options, and investments just really briefly. So let's look at the company before the stock market. Okay, this is just a regular company. Say they want to expand, but they don't have the capital to do so. So one of the options for the company is to IPO. Now, when you IPO, extending an initial public offering, what that means is you are now a publicly traded company, which means investors can now come in and invest in your company. When that company raises money, so does the investor. Once they IPO, it releases all the information to investors, and the reason is to give investors transparency to know if they're interested or trusting in that company enough to invest their money to gain capital appreciation. Mind you, the information that's released to the public is everything about the company, all their finances, liabilities, assets, how much money they've had left over after paying for their liabilities, balance sheets, income statements, cash flow. There's so much information that these IPOs require for a company to release to investors, to the public, to people like us who want to decide, is this a good company to invest in? Once the company releases all this information and an investor comes in and purchases that stock, they are buying a piece of that company. They are now a minority owner of that company. Now, another word for stock is called a share. So when you're purchasing a stock, you're purchasing one share of this company. So you're a minority owner of this company. Now, that doesn't mean you have a right to vote or to change laws within the company and stuff like that. Those benefits come later when you own a larger amount. But for now, when you're just starting to invest in maybe one company, you're a minority owner. So, essentially what investors are doing are looking at companies, seeing if they're a good company, and if they are, investing our money into the company to then gain capital appreciation. So, or passive income through dividends. So, we might ask, what makes a company good? And that's a great question. But the thing is, it's all up to you. You have to realize that you're your own boss. You have to start getting yourself out of the employee mind state and start putting yourself in an investor or trader or boss, mind state. So let's get a little bit into the analysis. There are two types of ways, from my knowledge, that people can analyze a stock, a company, a share, whatever. Okay? We have technical analysis. Now, these are the technicals. This is when you're looking at the chart. You're looking at the chart, you see all these lines, horizontal, vertical, you see, these graph looking things and numbers, the red, the green, those are all the technicals. So you have the charts, you have like the MACD, you have the support and resistance, you have the Bollinger Bands, you have the candlesticks, you have the moving averages. There are so many technical indicators that are communicating with you. Okay? Every single thing that is happening in the market on those on those charts that look very intimidating, if you take the time to just take it apart one by one, you'll really see that it's nothing to be scared of. In fact, it's communicating with you. Okay? So if you pay attention and study it, you can see what was it doing in its past, what is it currently doing in the present, and that will help you determine what it may do in the future. Now, never rely on one indication. If you do, you'll lose your money. Okay? Say if there's a chart, as we know, buy low, sell high, that's your capital appreciation. You sell it, that's your profit. So if it's low, maybe the RSI is doing something and you want to buy it based off what that RSI is doing. That's not necessarily the smartest thing to do, because that is going off of one indication, which you should never do. But that goes into the trading plan, which we're going to talk about after the analysis, because in order to trade, we need a solid trading plan. Another form of analysis are fundamentals. You have fundamental analysis, which are more like, the balance sheets, the income statements, the cash flow, the news, what celebrities are saying, that's making it go up or down. Like Elon Musk might mention something and it can skyrocket or drop, or the qualitative versus quantitative analysis as well. So when it comes to trading and or investing, it's going to take for you to come up with a trading plan. It's going to be vital for you to, first of all, understand, am I a trader or am I an investor? If I'm a trader, What kind of trader am I? Am I a day trader, which means I buy today and sell today? Am I a swing trader? I buy today, sell tomorrow, you know? What other kind of, traders are there? Intraday trader, all kinds of traders. Or are you an investor? Are you going to purchase something and sit on it and let it just appreciate and take it out 10, 15, 20, 40 years from now? You know? So are you a trader? Are you an investor? Are you both? With your trading plan, you're going to have to come up with your entries and exits. What's going to make you hop into a trade? Will it be 2 technicals and 1 fundamental? 5 fundamentals? 5 technicals? 2 technicals, 2 fundamentals? You have to really sit down and research this stuff and break it down to know what kind of trader or investor you are and what matches your skill set the most. So are you entering when it's at its low in the Bollinger Bands and then the RSIs? You have your 3 indications that it's low. Okay, I'm going to get in. But now that you're in, when are you going to get out? A lot of people like to get in, including me. There was a time where I hopped in a trade, XOM Mobile, and it's going up, 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 up. And I'm watching my profits grow right in front of me. It's really easy to keep that money in there and just let it keep going. But the thing is, the market never just goes up, 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 up forever. It never goes down, 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 down forever. It goes up and down, and it consolidates. Up, down, consolidates. Okay? So I'm going to get in when these 3 indicators show this, and I'm going to hop out at 10%. Once my profit reaches 10%, I'm going to set a daily limit so the computer can automatically take me out at 10%, or 20%, or 30%, or 80%, whatever you want. You're your own boss. Okay? Then you have to determine, are you going to use stop losses? Say if you have $800 and you think you want the stock to go up here, but it starts going down, down, down here. So this $800, you're already at minus 400. So if that scares you to the point where, you say, oh, I don't want to lose any more than 400, no matter what. If I've lost 400, take me out. So you can set your charts up in a way to where if you've lost 400, it'll take you out. I don't use stop losses, but it's highly advised that people do. You also have to think about your limits. Are you setting limits? Because sometimes you're in the stock market and it could be very volatile. It could be going up and down really fast. And there was a time where, I saw a profit. I was exiting a trade. As soon as I confirmed that exit, that 0.1 second of me pressing that button, it dropped. Profit gone. Because it's volatile and it's moving like this. So I might see my profit up here, click it out, and it's down here. So limits could be a lifesaver. To where you say, you wake up in the morning every day and say, once this reaches 10%, take me out. That's my limit. 10%, take me out. So you have to think about this. Do you want stop losses? Do you want limits? Then you have to think, are you going to be a fundamental trader or a technical trader? Some people are both. Some people focus all on technicals. Some people focus all on fundamentals. And it's going to be very vital that you understand analysis paralysis, because it might sound easy to say, oh, I'm just going to focus on all the technicals and all the fundamentals, the more information the better, right? But that can give you analysis paralysis, because each and every one of those things in between a comma have a huge amount of information within it. And that's just the company that you're looking at. So if you have 5 companies, and you have all this information that you're trying to learn about all these companies, these are all the things that you're going to have to think about. Are you going to be a fundamental trader, technical trader? And how many indications? Once you figure out if you're fundamental or technical, how many indications does it take for you to be comfortable with the fact that, okay, now I'm comfortable that this is going to go in the direction that I'm hoping? So a quick little example for me. I trade and I invest. I trade options. I invest stocks. Brokers. I have multiple brokers. And with stocks, I am in Fidelity. But when I'm trading options, I'm in Webull. So I do both. You can do both. You can pick one. As far as entries, I have 3 technical indications that will let me get into my trade. Before I feel comfortable getting in, I need to see 3 or more technical indications. And I exit at 10%. Not all the time. I have one option right now that is has raised 94.44%, which is a lot. So, like I said, I don't always do that. You can have as many trading plans as you want. Each company you have can have a different trading plan. You know, for Apple, you might be looking at the technicals, but for Verizon, you might be looking at the fundamentals. You know, like I said, you're your own boss, so it's going to take you to sit down and think about what you want to do and how you're going to create your trading plan. So I'm a trader and an investor. I enter with 3 or more technical indications because I'm a technical trader. I don't focus on fundamentals. I exit at 10%. I do not use stop losses, but I use limits every single day. I wake up and set my limits every day because the last thing I want is for a stock to reach 10,000, but I decided to sleep in. So when I wake up, it's back to $30. And then I missed out on that whole trade because I hit snooze. You snooze, you lose. Okay? So set your limits. At least I do. Like I said, technical trader and 3 or more indications. So that's just about my initial trading plan. It changes with time, but trading plans are very, very, very important. Now we're going to get into stock options. So now options are where investors are engaging with contracts with companies, and each contract is actually worth 100 shares. So you know, in stocks where you buy a piece or a share of that company, you're buying a share, 1 share. Well, in contracts and options, 1 contract is automatically 100 shares. You're essentially saying, I'm placing a bet that the current stock price will reach a certain point by this certain date. Basically, the goal is for the current price to get to the price that you bet on, which is called the strike price. So you want your price to reach the strike price by the expiration date. Now, of course, it's better to buy more time, because the more time you buy, the more time you're giving the stock market to go where it needs to go and to reach that point. But the catch, the more time you need, the more expensive it is. So, a couple of benefits of investing and trading. Of course, we have capital appreciation. You buy something at this price on this date, and this amount of time has passed, and now it's worth this much, and you can sell it, and you can take your profit. That is capital appreciation. You can do that investing, you can do that with trading, you can do that with options and stocks. All of it has capital appreciation. Another benefit of the stock market are dividends. Dividends are a form of passive income. So, say you're investing in a company and they take their profits and they reinvest in their company, as they should. Well, there are some companies out there who, once they make their profits, they're taking a big portion that they're investing back into their company, but there's still a little portion that they're giving back to investors to pretty much say, hey, thanks for investing in us. Here's a little change for you. And they do that pretty much quarterly. So maybe every 3 months or so, they're paying these out. Companies that pay dividends are usually like the more mature companies who've been around for a long time, who have a great brand awareness, who are known globally, like Coke or Pepsi. Because imagine you're investing in this stock, they're doing great, so you're making money, and on top of that, they're paying you dividends. So you have that capital appreciation and you have that passive income. In my opinion, investing in the stock market is better than saving in the bank accounts. Because when you're saving in the bank accounts, first of all, you have these monthly fees, not even including inflation. By the end of the year, you might have less money than what you started off with in the beginning of the year. Whereas when you're investing in the stock market, you're investing in an ETF that doesn't have a lot of volatility, but instead is less risky and a slow appreciation over the years. Yeah, it's more boring and it takes time, but your money is appreciating. I'm not a financial advisor. So, never use money that you need in the market. It'll be a big mistake for you to say, oh, I got $800, my rent is $1,000, let me throw this in the stock market so I can make $200 profit in the next 10 days. That's a mistake, okay? Because you can't force the market to do what you need. You need to learn the company, learn the technicals and fundamentals, create your trading plan, and observe the charts to a point where an opportunity presents itself. You can hop in, you can jump on that, you can take that. Okay? If you just be like, and that was my goal when I first started off. I was like, I'm about to make $200 a day. And guess what? I'm sitting there looking at the charts all day waiting for that moment. So I spend 15 hours staring at a computer and I only make $200. That's back at the employee mind state. I'm trading my time for money.